Ever feel like you're always a step behind in the stock market? Like by the time you hear about a hot stock, it's already shot up? Well, there's a famous financial theory that explains exactly why that happens. It's called the efficient market hypothesis, or EMH for short. Don't worry, it sounds complicated, but the idea is actually super simple. Imagine a giant, super-fast news-gathering machine that instantly knows everything about every company. It knows their latest earnings, their secret new projects, even what the CEO had for breakfast. Now, imagine that this machine shares all that information with every single investor at the exact same time. In that world, how could you possibly get an edge? You couldn't, right? The moment any news comes out, good or bad, the stock price would instantly adjust to reflect it. That's the core idea of the efficient market hypothesis. It says that the stock market is that super-efficient machine. All known information, public announcements, analyst reports, economic data, is already baked into a stock's current price. This means, in theory, that stocks are always trading at their fair value. So that hot tip from your cousin? The market probably knew about it weeks ago and the price has already moved. The EMH comes in 3 flavors: weak, semi-strong, and strong. Let's break them down. The weak form is the most basic. It says you can't predict future prices by looking at past price movements. All those fancy charts with patterns like head and shoulders or double bottoms. According to weak form efficiency, they're useless for consistently beating the market. The past doesn't predict the future because any information from past prices is already reflected in the current price. Next up is the semi-strong form, and this is the one most people talk about. It says that stock prices adjust rapidly to all publicly available information. This includes not just past prices, but also things like earnings reports, news articles, and company press releases. So, when a company announces amazing quarterly earnings, the price jumps almost instantly. By the time you read the news and try to buy, the opportunity is gone. This is why it's so hard to profit from public information. Finally, we have the strong form. This is the most extreme version. It claims that stock prices reflect all information, both public and private. Yes, that includes secret, inside information that only company executives know. If this were true, not even insiders with secret knowledge could beat the market, which we know isn't entirely the case. That's why insider trading is illegal. Most experts agree that markets are probably not strong form efficient, but it's a useful concept to think about. So, what does this all mean for you, the everyday investor? Does it mean you should just give up trying to pick stocks? For many people, the answer is kind of yes. If the market is mostly efficient, trying to consistently find undervalued stocks and beat the market is incredibly difficult, time-consuming, and often a losing game. It's like trying to win a race against thousands of the smartest, fastest people in the world, who all have supercomputers. This is why so many successful investors, including the legendary Warren Buffett, recommend a different strategy for most people: passive investing. Instead of trying to pick individual winning stocks, you simply buy a piece of the entire market through low-cost index funds or ETFs. An S&P 500 index fund, for example, lets you own a tiny slice of the 500 largest US companies. By doing this, you're not trying to outsmart the market. You're just riding along with it. History has shown that over the long term, the market as a whole tends to go up. This strategy accepts the idea of market efficiency and uses it to your advantage. You save time, reduce stress, and often end up with better returns than those who are constantly trying to time the market. Of course, the EMH is a theory, not a law of physics. There are critics who point to market bubbles and crashes as proof that markets aren't always rational or efficient. And there are legendary investors who have consistently beaten the market over long periods. But these are often the exceptions, not the rule. For the vast majority of us, understanding the efficient market hypothesis can be a liberating idea. It frees you from the pressure of picking the perfect stock and empowers you to build wealth through a simple, proven long-term strategy. So next time you feel the urge to jump on a hot stock tip, remember the EMH. The market probably got there first. Maybe the smartest move is not to play the game of outsmarting everyone, but to simply own the whole playing field. Thanks for watching, and don't forget to subscribe for more simple explanations of complex financial topics. See you next time.